Welcome to The Explainer. Today, we're going to put on our detective hats and crack the case of a document that companies release every few months. Now, it can seem pretty dense and intimidating, but trust me, it is packed with some incredible clues. Our key piece of evidence today is this, an official filing from a company called Motherson. Now, at first glance, it's just pages of numbers and text, right? But hidden inside is this incredible story about global business, financial health, and a truly sprawling corporate empire. So, to figure it all out, we're going to follow a 5-step investigation. We'll move from the what and the why to the who, how much, and, the all-important so what. All right, let's dive in. Okay, first things first. Every good detective needs to understand the nature of the evidence. So what exactly are we looking at here? Well, this isn't some secret internal memo. Nope. It's a formal letter, and it's addressed right to India's major stock exchanges, the BSE Limited and the National Stock Exchange. So by its very nature, it's a public declaration for literally anyone to see. Now, the company specifically mentioned something called SEBI Lauder. You can just think of these as the official laws of financial reporting. These are the rules that force companies to publish their results, and it's all about making sure that every single investor, big or small, gets the exact same facts at the exact same time. It's all about creating a level playing field. Okay, so the company has to release this info, but can we actually trust what they're saying? I mean, how do we know the numbers are legit? That's where our next clue comes in. This report includes a review from a firm of chartered accountants, S.R. Batley & Co. LLP. These are the independent fact-checkers. They're like the third-party experts hired to come in and check the company's homework. And this is absolutely crucial. There's a clear separation of duties here. Motherson's management, their job is to prepare all the numbers. But the auditor's job is totally separate. They review that work and give an independent conclusion, checking for any major errors or misstatements. Now, for a quarterly report like this one, the auditors do what's called a limited review. It's not quite the super deep dive of a full end-of-year audit, but it's a standard procedure that gives what they call moderate assurance that the numbers are reliable. Think of it like a regular health checkup for the company's finances. Okay, so we've established the what and the who. But now the report starts to reveal something, something truly massive. This is where we uncover the sheer, mind-boggling scale of this company. Get this, buried deep in the auditor's notes is this fascinating little detail. The financial results for 71 of the company's subsidiaries were actually reviewed by other auditors. I mean, this single company is so big that one auditing firm can't even handle it all. And this phrase right here is key. It shows how the lead auditor is kind of like a master detective, gathering reports from this whole network of other professionals all over the world just to piece together the complete financial picture of this huge global entity. And this is where you really see that scale. The report has an annexure, which is basically a giant list of all the individual companies that make up the whole group. I mean, you can just see names from France, Spain, Germany, Brazil, China. We see they have extensive operations down in Mexico. Then you see all these companies across the USA, multiple different entities over in Japan. And really, the list just goes on and on and on. It's painting this picture of a business that spans nearly every single continent. And when you finally get to the end of that list, you find the grand total. This single report isn't just about one company. It's consolidating the financials of 305 different subsidiaries. Think about that for a second. That means managing different regulations, different currencies, different markets, all of it rolling up into one set of numbers. So, now that we've uncovered just how huge this global empire is, we get to the heart of the matter. How did it actually do in the last 3 months? It's time to check the scorecard. This chart really gets to the most basic question. Did they make more than they spent? And for this quarter, the answer is a very clear yes. Revenue outpaced expenses, and that's always the first sign of a healthy performance. The top line number is their revenue from operations, and we're talking about over 31,000 crore rupees. That's the total amount of money they generated from their main business activities in just 3 months. It's staggering. So, if we look at the key numbers from the official statement, we can see exactly how they got to their profit. They took their total income, they subtracted all their expenses, everything from materials to employee salaries, and that left them with a profit before tax of over 1,400 crore rupees for the quarter. For a global auto parts supplier, that's a really strong signal of both high demand and some very effective cost management. All right, so we've followed the clues, we've verified the facts, and we've seen the results. We've pretty much solved the case of what's in this report. But that leaves us with our final question. Why does any of this matter? Well, these filings are just crucial. They ensure transparency, they hold a company's management accountable for their performance, and they give investors the hard data they need to make smart decisions. This regular, verified flow of information, it's really what keeps the entire market fair and healthy for everyone. In the end, you have to remember this report is just one chapter in the ongoing
Welcome
story of
back
a
to the deep
massive
dive.
global
Today
company.
we are putting
It's just
aside the usual stack of articles, the op-eds, all the heavy research papers. We're doing something a little different.
Yeah.
We're performing a forensic autopsy.
A financial autopsy,
Yeah.
if you will. Though, looking at this data, I'd say the patient is very much alive, maybe even kicking.
That's a fair distinction, a very fair distinction. We have exactly one piece of source material in front of us today, but it is dense. We are looking at a single stock chart. Specifically, it's a daily candlestick chart for a company called Motherson, trading on the National Stock Exchange.
Yeah.
And if you're listening to this, on your commute or at the gym, don't worry.
Right.
You don't need to see the image to get this. We're going to visualize the data so clearly you'll see it in your mind's eye. Because a chart like this, it isn't just lines and bars. It's almost a crime scene.
It really is. It's a map of human psychology. It's fear, it's greed, panic, conviction. It's all playing out in real time.
And we're looking at a very specific timeline here. It's from late October 2025 right up to the trading action of February 10th, 2026. And visually, when I first looked at this, the first thing that just hit me was the volatility.
Oh, yeah.
This is not a flat line. It looks like the heartbeat of someone who just finished a sprint, then passed out, and is now, I don't know, waking up with a shot of adrenaline.
That's a vivid way to put it. It really captures the essence of what we call market structure. You've got an impulse, you've got a correction, then you have a resumption. And this chart is, well, it's a textbook example of all three happening in a very compressed time frame. It's a story of resilience.
So let's break down this narrative arc. We're looking at a window of, about 3.5 months. Visually, if you trace the price action, it sort of forms this massive N shape.
An N shape or maybe a check mark?
Yeah, a check mark that got dipped in deep water before just shooting back up.
Well, that deep dip is the key to the whole story. But to understand the dip and why it matters so much right now in February, you have to understand where it came from. You've got to look at the setup.
Right. So phase one, the climb. Let's rewind to late October, November of 2025. The stock was just hovering in the 100 to 106 range. Looking at the chart here, it looks incredibly tight.
Very tight. Yeah.
Small candles, not much movement. It's almost boring.
That boring phase is actually fascinating if you know what you're looking for. That's what we call accumulation or consolidation. It's the silence before the noise.
Yeah.
When you see a stock trading in a tight range like that, where the highs and lows are all compressed, it usually means the market's agreeing on a value. It's building a base. The smart money is quietly accumulating shares without spiking the price. They're packing their bags for the trip.
And clearly, they finished packing because come December, the train just leaves the station. From November through late December, it's just this steady march upward. Green candle after green candle, it hits a peak. Everyone's happy, checking their portfolios with a smile. But then
The mood shifted.
it shifted hard.
And markets don't go up in a straight line forever. But this wasn't just a pause. This brings us to the most painful part of the chart for anyone holding the stock phase 2, the correction.
It wasn't just a correction, it looked like a capitulation. Starting in late December, the price starts to bleed. But look at mid-January. That's the bottom of that N shape. It didn't just gently lower, it looks like it fell off a cliff. The candles get longer and redder.
This is where the psychology gets so interesting. In mid-January, we see the price slice right through every support level. It broke the market structure. For a technical trader, that is a red alert. It signals that the trend has broken. It's the moment where the fear really sets in.
It looks like panic selling to me. When I see those long red bars just pushing straight down, that tells me investors are rushing for the exit all at once.
Exactly. It's a crowded theater and someone yelled, "Fire!" That is a liquidity flush.
Yeah.
It flushed out all the weak hands, the people who were just renting the stock, not owning it.
Yeah.
But, and this is the plot twist, it didn't stay down.
No, it did not. We enter phase 3, the resurgence, and this is where we are right now in February 2026. The recovery is almost violent in its speed. I mean, just look at the angle of ascent here.
It's a classic V-shaped recovery, or maybe that checkmark recovery you mentioned. The angle of the ascent in February is steeper than the angle of the descent in January. That tells you something crucial about the intent of the buyers.
It tells me they're aggressive. They aren't just buying, they're chasing the price. They're afraid of missing out.
Precisely. When a stock recovers slowly, it suggests caution. It suggests people are just dipping their toes in. But when it snaps back like a rubber band, like Motherson has done here, it suggests that the drop in January was viewed by the big players not as a crisis, but as a discount sale.
A buying opportunity.
They stepped in with very heavy pockets.
Okay, so let's zoom in. I want to get forensic on the star of the show. We need to talk about the very last bar on the far right of the chart, the data from February 9th and 10th. This single candle seems to encapsulate the entire bullish sentiment, but it also has a little warning sign attached to it.
The current candle. Yes, this is the bleeding edge of the data. This is where the battle is happening right now.
I'm looking at the OHLC data open, high, low, close listed at the top left of our source. Let's decode this, because for a listener who doesn't stare at charts all day, these four numbers tell a mini story of a single trading session. We have an open at 124.90.
Okay, so the bell rings, market opens, and the price is agreed at, what, roughly 125?
Then we have the low at 123.28.
And that's important context. It means at some point early in the session, the bears, the sellers, they tried to push it down, they tested the waters lower, tried to break the spirit of the open, but they failed. It only dropped about $1.50 before buyers just swarmed it.
And when you say swarmed, they really swarmed it. They pushed it all the way up to a high of 131.89.
That's a massive intraday move. I mean, think about that range. From a low of 123 to a high of almost 132, that's nearly a 7 or 8% swing in one session? That is pure momentum. That is the bulls just running with the ball.
However, and this is the detail that catches my eye, the close. It closed at 129.22.
Which is still a very strong close, well above the open.
But it's not 131.89. And visually on the chart, this creates that little line sticking out of the top of the green bar, the upper wick.
The shadow, yes.
Does that wick worry you? To me, it tells a story of rejection. It says the bulls marched all the way to 132, planted their flag, and then got pushed back. They couldn't hold the territory.
It is the only blemish on an otherwise perfect bullish day. That wick represents overhead supply. It means there are sellers lurking at that 130 to 132 level. Maybe it's people who bought back in December and are finally seeing their money back, so they're selling to break even, or maybe short sellers stepping in. It's not a deal breaker, but it is a caution sign. It says the path to 135 isn't going to be a straight line.
It's like they hit a glass ceiling and bounced their head.
Exactly. They need to regroup before they can punch through that ceiling. The market needs to digest that 130 level.
Okay, let's move away from the raw price candles and look at the overlay. We've got these three wavy lines snaking across the chart. Looks like a highway with a median strip.
Yeah.
I'm assuming these are Bollinger Bands or a similar volatility channel.
You nailed it. You have an upper band, lower band, those are the green lines, and a central moving average, which is the red line. And these are fantastic tools for understanding relative price. They tell you if the price is high or low relative to its own recent history.
Let's talk about that red line in the middle first. It seems to act like a magnet.
That's the mean, the average.
Right.
In a healthy, boring market, the price loves to hug that red line. It returns to the mean. You can see back in November and December, the price used that red line as a staircase.
Right.
You would touch it, bounce up, touch it, bounce up. It was using the average as support.
But then look at the crash in mid-January. The price didn't just touch the red line, it smashed through it. It spent weeks living below that red line.
And that was the bearish phase. When you're below the mean, the average stops acting as a floor and starts acting as a ceiling. The stock is technically underwater. Every time it tries to rise, it hits that average and gets sold off. But look at what just happened in the last few days of this chart leading up to February 10.
It surfaced. It powered right back up through the red line. Didn't even hesitate.
That crossover is a critical signal. We call it reclaiming the mean. It tells algorithms and traders alike that the trend has shifted from negative back to positive. The submarine has surfaced and is now operating above water again.
And it didn't just surface. It looks like it's trying to fly. Look at the upper green line. The price is currently smashing right into it. It's practically bending the line upwards.
That is what we call riding the bands.
It sounds dangerous.
It is, but in a good way for buyers. Usually the upper band acts as a container. It says, okay, price is too high, push it back in. But when a trend is incredibly strong, like a breakout, The price will literally push that band upwards, forcing it to open. It's like stretching a balloon.
I see that visually. Back in October, the green lines were tight squeezed together. Now, here in February, the mouth of the alligator is wide open. The distance between the top and bottom green lines is huge.
That's volatility expansion. The squeeze in October built up the energy, and now we're seeing the release of that energy. The fact that the price is closing near that upper band confirms this isn't just some random fluctuation, it is a breakout. The market is effectively repricing Motherson to a new level.
But you always tell me, price lies, volume tells the truth. A price can be manipulated on thin trading, right?
Always check into the hood. If the engine isn't running, the car isn't going anywhere.
So I'm looking at the bottom of the chart. The vertical bar is labeled volume. This is the fuel gauge.
It's the lie detector.
Walk me through the comparison. When the stock was crashing in mid-January, what does the volume tell you?
It's interesting. The volume during the drop was messy. There were a few spikes, but it wasn't consistently massive. It's just the drop was more of a drift rather than a total structural collapse. The conviction to sell just wasn't overwhelming. But look at the far right. Look at February.
Bam! There's a massive green bar right at the end, and another big spike around February 1st. These are the tallest bars on the entire visible chart.
That is an institutional footprint. You cannot hide an elephant in a bathtub.
I love that image.
When you see a price jump of 4 or 5%, and it's accompanied by the highest volume bar of the quarter, that is not retail traders like you and me clicking buy on our phones. That's mutual funds, hedge funds. That's the big money entering the position.
So that validates the move. It means this isn't a fluke.
Completely.
Yeah.
If the price had gone up to 129 on tiny, weak volume, I'd say it's a fake out, a trap. I'd expect it to collapse tomorrow.
Right.
But rising price on rising volume, that is the holy grail. It means there's actual demand absorbing all the supply. For every seller at 130, there's a buyer saying, I'll take it.
Okay, so we have the price, which is bullish, the bands breaking out, and the volume, which is institutional confirmation. Let's look at the speedometer, the momentum gauge in the middle panel, the RSI.
For relative strength index.
Oh.
Classic. It just measures the velocity of the move.
It's a white line oscillating between 0 and 100. Let's trace the crime scene again. In mid-January, during the crash, this line went deep into the valley.
It went below 30. We call that oversold.
Which sounds bad, but for a trader looking for a deal, that's actually good, isn't it? It means things are too cheap.
It's a slingshot. When RSI hits 25 or 30, it's like stretching a rubber band as far back as it can go downwards. The selling pressure has exhausted itself. Everyone who wanted to sell has sold. There's nobody left. So the only way is up.
And snapback it did. I mean, look at the angle of that white line now. It's pointing almost straight up. It's crossing 54.0.
And this is a nuance a lot of people miss. Everyone looks for oversold at 30 or overbought at 70. But the most important level is actually 50.
The midpoint, the equator.
Exactly. When RSI is below 50, the bears are in control, the momentum is down. When it crosses above 50, which Motherson just did, it signals a regime change. Momentum is now mathematically on the side of the bulls.
But here's my question. We're at 54. We aren't at 70 yet.
Correct.
So does that mean we have gas left in the tank?
It suggests we aren't redlining yet. If the RSI was at 85, I'd be saying, whoa, take profits, this is overheating. But at 54, we're just shifting into fourth gear. There's plenty of room between 54 and 70 for the stock to keep running before it gets frothy.
That's a really powerful synthesis. So the volume says we have fuel, and the RSI says we have room to run.
And the price structure says we have changed direction. It's the trifecta.
Okay, I want to circle back to one thing you mentioned earlier, the wick. That rejection at 131.89. We've painted a very bullish picture here, but I don't want to be blind to the risks. What's the bear case here? If I'm a skeptic or if I'm shorting the stock, what am I looking at on this chart that gives me hope?
That's a healthy question. You should always look for the counter argument. If I'm playing devil's advocate, I'm looking at two things. First, that wick. It shows that 132 is a hard wall. If the stock opens tomorrow and just can't get past 130, we might see a double top or a short-term pullback. It implies that the sellers are defending that line.
And the second thing?
The speed of the ascent. I mean, we went from the basement to the penthouse in about 10 days. Markets rarely move in straight lines forever without taking a breath. It wouldn't be unhealthy. In fact, it would be normal to see a few days of red candles here, a pullback to test that red line we just crossed.
Testing the support, like checking the floorboards before you put the piano down.
Exactly. If it pulls back to the average and bounces, that confirms the trend is solid. If it pulls back and crashes right through it again, Well, then this whole rally was a bull trap.
A trap.
A dead cat bounce, as they say. Even a dead cat will bounce if you drop it from high enough. It looks like a recovery, but it's just physics, not life.
Yeah.
But looking at the volume on this chart, I doubt it. Dead cat bounces don't usually have this kind of institutional volume behind them. This feels like a true reversal.
So let's step back and look at the whole picture. We've covered a lot of ground, from the boring accumulation in October to the panic in January to this explosive recovery in February. If we had to summarize the story of Motherson for our listener, translating this forensic analysis into a narrative, how does it read?
It reads like a survival story. Motherson faced a severe stress test in January. The market asked, "Are you worth holding?" And a lot of people screamed no and sold. The price collapsed, the structure broke, indicators went oversold. It was a crisis.
But the crisis resolved.
It did. The character of the market changed. The smart money stepped in at the lows, absorbing all that fear. They were buying when everyone else was selling. Now, in February, we're seeing the result of that absorption. We have a breakout on high volume, confirming momentum, with room left on the RSI to run higher.
It's a U-shaped recovery with an exclamation point at the end.
And a question mark at the very top thanks to that wick.
That's the beauty of the market, isn't it? It never gives you a period. It only gives you commas and question marks. It's a never-ending story.
The chart tells you the history perfectly. We know exactly how we got to 129.22. We know the pain and the gain. But that hard rejection at 131.89 is the cliffhanger for tomorrow's episode.
So for you listening, next time you see a stock chart, don't just look for the green or red colors. Look for the struggle. Look at the wicks to see who won the daily battle. Look at the volume to see if they brought back up. And check the RSI to see if they're running out of breath.
Vital signs. Check the vitals before you make the diagnosis.
The patient, Motherson, looks like it's out of the ICU and sprinting again, but we'll have to watch that 132 level to see if it trips. That's all for this deep dive into the data.
Keep your eyes on the chart.
We'll catch you on the next one.